Joining me is Mike Liss. He's Senior Portfolio Manager at American Century Investments. Mike, welcome. When you say crimp demand, are you talking growth slowdown? I don't want to use the R word, but how much of a slowdown do you think?
Yeah, Kelly, it's good to see you. Just want to lay out our process is really bottom up. And so while we are aware of macro factors like interest rates and inflation, we are really driven by a bottom up process. And where that is leading us today is to consumer staple stocks, pharmaceutical stocks, and to energy and to banks.
Consumer staples, pharma or healthcare, some will call it energy banks. Now, I don't want to say these are super consensus, but as you're aware, they are. And like you said, you're bottoms up. You're going through and looking at the companies themselves, the balance sheets. What is it about that process that's driving you into these sectors? Why should people feel comfortable doing what the rest of the crowd is doing right now?
So, Kelly, what we're really trying to do are find higher quality companies. And these are companies that will do well in an economic slowdown or even a recessionary environment. They'll hold up better, but also in a growing economy, they will participate nicely as well. And so that's where our process is leading us today, towards consumer staples and pharmaceuticals, banks and energy, because they have better risk rewards. They have better valuations.
Sure. And some of the individual names may surprise people. For instance, Food Lion's parent company, I believe, Ahold Delhaize's. You also have General Electric in here, which has been a battleground company for a long time. Truist Financial. Let's start with the Food Lion parent company. Why this name?
So this is Ahold, and Ahold is very well positioned as a retail grocer. They have a 60-40 split in terms of revenue between the U.S. and Europe, and they're number one in the Netherlands and Belgium. And their strategy consists of increasing their mix of higher margin items like fresh food and private label, building their bowl.com businesses, which is like a mini Amazon in the Benelux countries, and improving their omni-channel offering. So we think it's trading at a modest valuation, a decent balance sheet, and a 3% dividend yield. We think it's a good risk reward here.
What about GE and Truist? Is there any sort of commonality there? Or would you describe them as very differently?
So I'd certainly describe them as different, but they've underperformed as of late, and we think that they have good risk rewards. Look, GE, very diversified industrial with leading market share across multiple businesses, including aircraft engines and medical diagnostic equipment. And their strategy is to streamline their operations, strengthen the businesses they've decided to stay in, strengthen their balance sheet by paying down debt, but they're going to split into three. And that's three smaller businesses that are much more focused, and we think this will allow them to grow faster. And that's a catalyst that's maybe a year or so away, but we think it's very important shareholder-friendly move, and we think it's trading at a pretty cheap valuation.
Yeah.
So then you talk about Truist, right? Truist was formed by the merger of BB&T and SunTrust banks, and they have a real opportunity to create value by integrating those two banks, achieving quite a bit of cost savings, raising their returns on capital. They have a lot of capital to begin with, so they are a safer bank relative to most banks out there, strong underwriting standards. They're also trading at a modest valuation, a 3.6% dividend yield. So we think they're also a good risk reward.